Bismillahirrahmanirrahim. Hi, Assalamualaikum, and a very good morning to all. So today we are going to held a roundtable discussion, and we are joined by 10 participants, one moderator, and 9 panels. The moderator is going to be me, Irfan Haras bin Hasanul Hanis. My matrix number is 052877. And later on, we will be introduced with other panels. So um, before you start your points and discussion, please kindly introduce yourself first. Okay, so the topic that we are given by Dr. Ahmad Azrin for our discussion today is how COVID-19 is changing credit risk models. So to start off, I would like to ask one Hafiz briefly go through about the topic today. So carry on. One.
Thank you, moderator, Irfan Haras. My name is Wan Muhammad Hafiz bin Wan Muhammad Ramli, metric number 052897. The COVID-19 pandemic crisis has triggered an extraordinary challenge across all sectors of economic impacting banking functions, particularly credit risk management, which was already the second most important immediate risk priority on CRO and board agendas, according to the most recent EY/IIF Global Brand Risk Management Survey. Faced with the unprecedented pace of magnitude of economic disruptions from the COVID-19 pandemic, risk modeling teams are challenged to develop a now, next, and beyond response. Current models in the prudential domains were built for economic downturns, but not a sudden halt in both supply chain and demand side of economic activity. The awareness of this impact is beyond anything in history, so risk modeling team must carefully question how and when historic data can be relevant to forward-looking credit analysis. That's all to me. Thank you, moderator.
Thank you, Wan, for the very good introduction to start off. So next, I would like to ask Ilham, what is credit risk and credit risk modeling? Can you briefly explain to us?
Bismillahirrahmanirrahim. Thank you, Irfan. Okay, first of all, what is credit risk? Credit risk arises when a corporate or individual borrower fails to meet their debt obligation. It is the probability that the lender will not receive the principal and interest payments of a debt required to service the debt extended to a borrower. On the side of the lender, credit risk will disrupt its cash flows and also increase collection costs, since the lender may be forced to hire a debt collection agency to enforce the collection. The loss may be partial or complete, where the lender incurs a loss of part of the loan or the entire loan extended to the borrower. Next, what is credit risk modeling? Credit risk modeling is a technique used by lenders to determine the level of credit risk associated with extending credit to a borrower. Credit risk analysis models can be based on either financial statement analysis, default probability, or machine learning. High levels of credit risk can impact the lender negatively by increasing collection costs and disrupting the consistency of cash flow. That's all for me. I'll pass back to Irfan. Thank you.
All right. Now we know what credit risk is. Thank you, Ilham. Next question will be asked to Said. Said, what is the importance of credit risk models?
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh to the moderator and all panels. First and foremost, thank you to the moderator for the question. Before I answer your question, I would like to state 6 elements found in credit risk models. Among them are know your customer, analyze non-financial risks, understand the numbers, give the deal a price tag, present and close the deal, and monitor the business relationship. To comply with the more stringent regulatory requirements and absorb the higher capital costs for credit risk, many banks are overhauling their approaches to credit risk. But banks who view this as a strictly compliance exercise are being short-sighted. Better credit risk management also presents an opportunity to greatly improve overall performance and secure a competitive advantage. So I think the major benefit for integrated quantitative quantitative credit risk management is to reduce revenue losses. Monitoring your credit risk allows your executive management team to understand which potential clients may come at too high a risk and above your pre-identified risk tolerance. Credit risk, if correctly identified and managed, can be leveraged as a strategy opportunity. Through effective credit risk management, your business is able to greatly improve overall performance and secure a competitive advantage. This was demonstrated by South African banks being less affected by the global financial crisis than their international counterparts. This was due to rigorous and highly effective credit risk identification, assessment, and management. So I think that's the answer for your question. I will pass to Ifan. Thank you.
Thank you, Saiful Zafri. Now we know what are the importance, and it is really important to know what credit risk model are. Next, ideal. What are the types of credit risk, and what are the factors affecting credit risk modeling? Can you tell us, Ideal?
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Can you hear my voice?
Yes.
Yes, Ideal. Yes, you can proceed. Okay.
There are three types of credit risk. First, credit default risk. Credit default risk occur when the borrower is unable to pay the loan obligation in full, or when the borrower is already 90 days past the due date of the loan repayment. The credit default risk may affect the credit sensitive financial transaction such as loan, bonds, securities, and derivatives. The level of default risk can change due to a broader economic change. It can also be due because of a change in a borrower's economic situation, such as increased competition or recession, which can affect the company's ability to set aside principal and interest payment on the loan. Second, construction risk. Construction risk is the level of risk that arises from exposure to a single counterparty or sector, and it offers the potential to produce large amount of loss that may threaten the lender's cooperation. The risk result from the from the observation that more construct portfolios lack the diversification, and therefore the returns on the underlying asset are more correlated. The last one is country risk. Country risk is the risk that occur when a country frees foreign currency payment obligation, resulting in a default on its obligation. The risk is associated with the country political stability and macroeconomic performance, which may adversely affect the value of its assets or operation profit. The change in the business environment will affect the company's operation within a particular country. And the factors affecting credit risk modeling have three types. First is probability of default, or POD. POD is sometimes arrived as POD is the likelihood that a borrower will default on the loan obligation. For individual borrowers, POD is based on combination of two factors, is credit score and debt to income ratio. Second is loss given default, or LGD. LGD refer to the amount of loss and that a lender will suffer in case a borrower default on the loan. And the last but not least is exposure at default, or EAD. EAD evaluates the amount of loss exposure that a lender is exposed to at any particular time, and it is an indicator of the risk appetite of the lender. EAD is an important concept that references both individual and corporate borrowers. It is calculated by multiplying each loan obligation by a specific percentage that is adjusted based on the particular of the loan. I think that just from me. Thank you.
Thank you, Aidil. So we have credit default risk, construction risk, and country risk. Now, I would like to ask one question, not to one, but two panels. I would like to ask Shaki and Shah, why have credit models broken down in the COVID-19 environment right now? Any one of you can answer this question. Shaki and
Okay,
Shah.
thank you. Okay, thank you for the moderator for the question. Okay, in my opinion, most of the model will build on historical data from the last decade, which is not representative of the current environment. The traditional data source they typically use struggle to capture the complexity and pace of the current economic environment. Also, credit model generally presume a gradual impact of the environment on loss, with lag ranging from 1 to 6 months. The estimated model parameter will exacerbate prediction due to any sudden macroeconomic movement. Current economic volatility is likely to generate unintuitive or counterintuitive estimate if one really heavily on the model. Credit risk model will also need to be recalibrated to reflect a forward-looking impact of the macroeconomic scenario on structural credit factor, challenging where historical relationship hold and applying new approach where they don't. Okay, that's from me.
Thank you to my partner Hakim Shakir. Otherwise, additionally, Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Otherwise, additionally, the payment holiday and forbearance intervention along with the closure of asset market have clouded typically indicators such as current delinquents that are often used to project future losses. Credit models are really input about the presumed macroeconomy forecast. They typically use a traditional economy theory concept of general or partial equilibrium at their core to project the future. Such forecasts may be completely unreliable as the artificial shutdown of many consumer goods and service market has pushed the economy into a state of disequilibrium. To compound the economy forecasting problem, government intervention such as a temporary income replacement program to mitigate unemployment may not to be fully factored into a project employment challenging. The credibility of the forecast clearly there are sufficient limitation in the use of assigning credit models in current environment. We believe that the area that model owners should be exploring in order to ensure that output of their model remain valid and robust under the current circumference. Uh, that's all from me. Thank you to moderator for a good question.
Thank you to both of you, Shah and Shaki. And now I would like to ask Mahadi, what is the quest for new data and early warning indicators? Would you like to point your opinion for that question, Mahadi?
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Thank you for our moderator today. So today I'm going to explain my opinion. Okay, so what is the quest of um, new data and early warning indicator? So from analysis of current transaction flow, which is in bracket, level, frequency, and volatility against pre-COVID-19 levels can help track the performance and risk of SME and corporate during the recovery period and allow target intervention. In some cases, historical financial indicator could be supplemented or replaced with a transactional data-based financial index. Going forward, bank should explore opportunities to gain better insight by using a range of other data sources including value change, linkage data, health, geolocation data, e-commerce, and electronic tax filing. And this will raise question around the sustainability of current data management infrastructure. Institutions that, until now, were reluctant to invest in high-frequency big data platform may now need to accelerate their technology spend as part of their next and beyond the COVID-19 triggered change in the bank of initiative. To gain access to untapped data sources, banks may need to expand their ecosystem and establish new, new relationship with external. Alright, so according to the EY and IIF Global Bank Risk Management Survey that I have researched, firm expected a significant increase in the application of this method for credit decisioning over the next 5 years, utilizing the broader range of data. We believe the pandemic will accelerate this process and will act as a trigger to formulate complementary credit risk assessment and also framework that can also be used for new waves of challenge related to climate change, geopolitical risks, or broader sustainability issues. It is critical to design approach that do not that do not follow the same over reliance on historical trends that may not fit today's crisis, while also not inappropriately amplifying short-term correlation in current data. While it is important to enhance the efficiency of the methodology for today, model risk management capabilities, and approach the lack of distortion of data in fundamental. That's all from me. Thank you to Ifan.
All right, thank you, Mahadi, for that very wisdom point of view. And now, Adib, I'd like to ask you one question that is very important. How can we solve this problem of credit risk um more efficient and fast? Adib, Taufi, would you like to answer this?
Thank you for me, Ivan Haras. Okay, first of all, we can adjusting to a new dynamics in credit risk management. From the perspective of financial institution, the condition that the COVID-19 crisis triggered have specific implications for managing and mitigating credit risks. In the past 3 months, banks have been adjusting to new dynamics and exploring potential new approach to the challenge. The analysis gauged the impact of the crisis on national or regional economy as whole, the impact by sector and subsector. So, specific credit risk problem requiring real-time monitoring. The analysis were already revealing the 5 unique effects this crisis on credit risk. Okay, the first three, the effect on underwriting monitoring. In the present crisis, change in creditworthiness differ by sector and subsector to a greater degree than they did in previous recession. Certain industries such as food distributor did better in the crisis and struggled to meet rising demand. Others such telecommunication and pharmaceuticals were little effects, but as will we know, certain sectors such travel, transportation, tourism and hospitality have been severely challenged. A sector and subsector analysis of the corporate loan portfolio of one Spanish bank clarifies such a difference. The secondly, we can do a sound or better capitalized financial system. The financial system is fortunately better equipped for a rapid crisis management today than it was in past crises. Banks are in much stronger in capital position, partly as a result of regulatory reform implemented since the global financial crisis of 2008 until 2009. That's only from me. Irfan Haras. Thank you.
Okay, thank you, Adit. Thank you. Okay. Marwan, can you add some more on the point of how banks can manage credit risk during COVID-19 crisis? Marwan?
Thank you, Irfan Haras, for the question. As we all know that due to COVID-19, banks are under pressure to provide financial assistance to their consumer and their commercial clients. So seeing how banks look at credit risk today is materially different from how they look at it just a few months ago. They have been forced to accept more risks. And I bet all banks in Malaysia are already seeing a significant raise in the number of customers that asking for credit and credit management. We also can see that small and medium-sized company are looking for credit lines because their revenue are slowing and they are still need and trying to pay their employees, their supplier and other expenses such as rent and many more. So to answer the question how banks can manage credit risk during this COVID-19 crisis, it is important to remember that this is an economic crisis, not a banking crisis. It will be harder for bank to manage credit risk. First, because the need for credit is higher, and the second one is because bank will have to be more lenient in their definition of financial hardship. And as we all know that during this COVID-19, a few moratorium given by the BNM. The first one is BNM. BNM announced a 6-month deferment period for loan by both retail and commercial borrower. And the second is some major Malaysian banks are also mentioned that they would not compound any interest on the deferred payment for this period. The third one is bank will also allow individuals to convert some of the outstanding balance of unsecured credit card balances to a term loan of not more than 3 years. And the last one is bank will also now assist corporate in restructuring some of their loan to support their sustainability of businesses and job. I think that's all from me. I pass to the moderator back. Thank you.
Thank you, Marwan. Now that all of our panels have speak up about this topic, I think we are already in the end of this roundtable discussion. It was really fun indeed to hear from all of you. Thank you to all that participates. Thank you to all panels. And I think that's all. Thank you so much.
You're most very welcome, Ifan.